Good morning. Can you hear me okay? All right, perfect. Well, we had closed the Zoom call because we had about 10 people RSVP and we waited about 10 minutes and no one had logged on. So we had closed it out and then I saw you join. So I'm glad y'all were able to hop on. Thank you for joining us. So you didn't miss anything because we didn't start. Um, so I'll just chime in here. Cory, are you talking?
I'm unmuted, so
Okay, cool. I just wanted to make sure you were up and running. Christine, it's great to see you. It's been a very long time. Shay, I can't see you, but hello. Thank you for being with us today. And since we have a small group today, we will run through this quickly, try to let y'all know what we're seeing in the marketplace and hopefully provide a little bit of good information as you're meeting with your clients moving forward for the rest of the year. So first and foremost, Chad Helmcamp, BWC Lending here, owner operator, started this back in 2019. Cory joined me about 3 years ago. He and I are the two originators here. And then Chris is the person who makes everything look amazing. So thank you, Chris, for all that you do. I'm going to share my screen real quick with our presentation. And the goal of this is to try to talk for about 10 or 15 minutes and then open it up for questions. All right. So again, this is our contact card information. So if you want to scan this, you can. It'll give you all of our information. But we will send this out after our presentation here. So let's just dive in. Rates, they're better. They're better than they were 6 months ago. So we use the Freddie Mac mortgage market survey that they produce every Thursday, and it'll show the average rates for the last week. And you can see in November of last year, we were around 7.76, which was about as high as we've seen. And then as of last week, we were at 6.89, and it's improved just a little bit this week as well. So we are definitely trending in the right direction. And now it seems like there's continuous news that we think that this trend could continue. So a little bit of economic news. Yesterday, the builders came out, the National Association of Home Builders, and single family starts are down 4% year over year. Permits are down 3% year over year. So not really great news considering our inventory issue. And builders are scaling back just due to the high rate environment. More expensive for them to build homes, more expensive for their buyers to buy the homes. And I'm sure you all are seeing it out in the market that the builders are providing a lot of incentives for their buyers to get them into the homes. They're just having to do that to get buyers interested. Demand is down. That's what they're saying on a national scale. I know Houston's a little bit different, but I would imagine they're seeing it a little bit as well. One of the custom builders I work with here in town, he told me that things really slowed down about 60 days ago, sort of made them pretty anxious. The Fed. So I would say here's the good news. At the beginning of the year, what caused rates to spike at the beginning of the year was economic news was coming out. The inflation numbers were coming out stronger than anticipated. And so with higher inflation, thus no real chance of the Fed cutting rates. So we saw mortgage rates spike. Well, now we've had 2 months in a row where the inflation numbers are better than expected and trending closer to that 2% target that the Fed wants. And we have two Fed members this week speaking, say they're closer to cutting. Rates are going to be warranted in the coming months. Right now, the market is predicting a greater than 70% chance that we're going to see a quarter reduction in the Fed rate in September. So that's what the market's pricing in right now. Of course, all it's going to take is a bad inflation number next month, and maybe that gets tabled. But so far, it seems like that's the expectation. And now people are saying we could see as many as 3 rate cuts this year. So that's the good news. As far moving away from mortgage rates and what we expect, I'll just say very quickly, my prediction with rates is I think rates are going to stay in the mid to high sixes for most of this year. If we do continue to see inflation improve, I think we're going to see those rates come down closer to 6% by year end, which would be, I think, amazing. And my expectation is the moment we see 6% with no points or high fives with points, that we're going to see the market really flood with activity and lots of buyer activity pick up. I put this slide in here just because does everybody know what trigger leads are? Have you heard of the term trigger leads? Okay. Well, if you're working with buyers, I definitely want you to know what this is. When a buyer applies for a mortgage, we check their credit. When we check their credit, the bureaus sell that information to other mortgage companies. And then our buyers, your clients, get inundated with calls, texts, emails, you name it. It's not uncommon for a buyer to get anywhere between 20 to 30 text messages or calls in a 24-hour period. So to say it's annoying is an understatement. And obviously you can imagine there's a lot of mortgage companies out there that don't want this bill to pass, but there's a lot of mortgage companies like ours who do want it passed because we're tired of our clients being annoyed and harassed the way that they are. So this is the legislation that's been proposed. I don't know when it's going to make it to the floor to be voted upon, but it does seem to be that there's a lot of people pushing hard to potentially pass this legislation to ban this practice. All right, I'm going to turn it over to Cory and let Cory talk about these next few slides.
Yeah, I mean, this slide is, I think if you compare this slide a year before, you'd see that the change we circled the change in the single family sales price from June 23 to June 24. We can see that prices are still going up. However, they've kind of seemed to slow down a little bit. I think last year, this time, we were somewhere around 3% or so, but prices continue to go up, even in a market where rates are elevated. Chad, I don't know if you're controlling it. You are. Okay. This is a slide we use in almost every presentation that we give. It's the cost of waiting. And so we've taken a $450,000 home today at a 6.75 interest rate and compared this same home to 3 years from now, when at a 4% appreciation rate, that home is now worth $506,000. If the rates are at 5.25 3 years from now, the borrower is going to save $105 a month, but what they didn't gain was $56,000 in equity. So there's a real cost of waiting, and this is what we try to illustrate when we talk to our buyers, that if you can make the payment work now, it's better to buy now versus wait. This is just an information. We also include this slide in just about every presentation that we do. This is just good information to have on hand. It talks about 4 of the most common products that we use: FHA, VA, conventional, and jumbo. The most commonly used is conventional loans, and they're the most unique when it comes to seller contributions. If the borrower is putting less than 10% down, they can only get 3% in seller contributions. If they're putting 10% or more, they can get 6%. And we don't have it on here, but if they're putting 25% or more down, they can get up to 9% in seller contributions. So it's a little different than the other products. Whereas FHA doesn't matter what the down payment is. It's the max seller contribution is 6% and VA is 4%. Also on the max loan amounts, they change every year. So currently in 2024, FHA max loan amounts are $498, $257. So if you've got a buyer purchasing in the higher, 500, 600, 700, they wouldn't be eligible for an FHA most likely. And then conventionals right now, the loan amounts, the max conventional loan amounts are $766, $550. Jumbo, that can vary. Jumbo loans are private loans that are held at each individual bank that offers those products. So this is just kind of a general idea of what a down payment requires for a jumbo loan and a max loan amount. But these numbers can differ between each bank that offers jumbo products. But this is something we like to include in all of our presentations.
And I'll just add real quick on the jumbo side, because I was just pricing a client yesterday that is looking to buy a $2 million home, really wanted to buy before they sell. They can income qualify to buy before they sell. The challenge is they just don't have enough funds for the down payment. And I looked at doing 10% down for him, and the rates were just atrocious. So although there are lenders that say they'll do it, the terms are not very good. And I'll just say this, that if you're buying a house that's going to be a jumbo loan, which will be any loan amount over 766,000, you know, typically 20% is really what's going to secure the most competitive rates.
So we put this slide in here. How are buyers in this market, and what can a 10K seller credit do for your buyer? So this is your initial offer that you make, asking for a 10,000 seller credit up front. What can the buyer do with that? Some of you may have heard about 2-1 buydowns. 2-1 buydowns are temporary buydowns. They're only in force for the first 2 years of the loan. So this is an example where a buyer is purchasing a $450,000 home. They're putting 5% down. The loan amount is $427,500. The interest rate is 675. That's the note rate. But in year one, if they're taking advantage of a 2-1 buydown, their rate will be 475, and in year two, it will be 575. And you can see, if you scroll over to that fourth column, or I should say the fifth column, you can see the savings in that first year of $542 a month. And the cost of this product, so if the buyer was purchasing a $450,000 house, putting 5% down, the ultimate cost is highlighted there in yellow. It's $9,848.52. This has to come from the seller. So when you're doing a temporary buydown, a 2-1 buydown, the seller must be the one who's contributing towards that buydown. The buyer can't pay for it themselves. So a $10,000 credit up front would allow this buyer to be able to take advantage of a 2-1 buydown, where they could have some real savings in the first 2 years, and it kind of helps them ease into their mortgage payment. So it's a really nice product. It's one that we've done more and more over the last 2 years, especially for a lot of our first-time home buyers. So if you're not thinking about this, even on the seller side, we've had some agents reach out to us that are listing homes that have asked, you know, hey, can you show us kind of what a 2-1 buydown and how that might help a potential buyer? So this is a unique product that we have seen used more often. It's become more common with a lot of our first-time buyers. But this is what a temporary buydown looks like. For 3, it's going to go to 675. So it's short term. Those savings are only for the first 2 years. The next slide is a permanent buydown. So if they were to take that same $10,000 credit, how would that impact their monthly payment and their interest rate? And so if you look in the first column, we have a purchase price of $440,000 versus column 2, where we have a purchase price of $450,000. So in both of these scenarios, the seller is walking away with $440,000. So the question is a price reduction of $10,000 more impactful, or purchasing that home for $450,000 and asking for a $10,000 seller credit? And as you can see in this example, the payment on the second option at $450,000 with a $10,000 seller credit is lower by $148 a month. So the impact and the savings over a 10-year period, which you can see at the very bottom, is $26,000. So the impact to the buyer is more monthly savings, a lower interest rate. However, they are going to have a higher loan amount because they're purchasing the home for $10,000 more. But when buyers see this is what many times will influence a decision to ask for that seller credit up front, so that they have the option to either entertain a temporary buydown or a permanent buydown. Chad, I think you wanted to. Do you have something to say? And I think you wanted to chat about the next slide. And you're also on. I think you're on mute too.
Thank you for reminding me. Yeah, so the buy downs are obviously a very big part of the market we're in, and I'll just give my history on buy downs. So in a normal market, which we have not been in a normal market for over 2.5 years now, in a normal market, a 1% discount point would buy your rate down a quarter. Okay, in this market today that we're seeing, a buy down can be a 3/8 to a half, or even more if they pay more in discount points. It really just depends upon the client. I think the scenario here that Cory has them paying over 2 discount points to buy down the rate. And so, yes, it's a substantial buy down, but we're just seeing more and more people do it. And it's also what a lot of the builders are doing out there. Those are the incentives they're putting out there. to show significant buy downs to the buyer to help the payment be more manageable. So I think this is going to be something that's going to be around with us for a while. And with payments, affordability being such a big part of the conversation, it's going to be a big thing moving forward. All right, buyer paying agents commission. So obviously this is a very big topic of conversation, has been all year. I don't see it going away. And unfortunately, there's still not a lot of clarity on some things. And so before we got on the call this morning, I called our closing attorneys with Blackman and Graham just to ask, have they heard anything new, anything else we need to know about? And the bottom line is, he said that the DOJ, Department of Justice, has come out and basically said they're not sure that the settlement is enough. Don't really know what that means, but basically means that things are sort of still pending and sort of still on hold as it relates to how this is all going to play out. So we just wanted to show a few things. Now, I will say this, if you don't know this, FHFA, which controls Fannie and Freddie, so conventional loans and FHA loans, have come out and said that if the seller pays the buyer's agent commission, that 3% will not count towards the interested party contributions that we talked about in the slides before. Okay. So if it's negotiated up front for the seller to pay for the buyer's agent commission, it doesn't mean that the buyer won't be able to get additional closing costs paid for by the seller. So I'd say that's the good news. What we worked up here in this slide is the column on the left is the way it is today, right? So if you structure a contract, seller's paying the buyer's agent commission, this is exactly what it would look like. If the seller refuses to pay the buyer's agent commission, we've got column 2 where the buyer would pay that cost. And you can see that their closing costs go up by about $13,000 roughly. So a pretty significant difference. And so it'll work for the client that has the cash. It's not going to work for the first-time home buyers and things that don't. And I'm not going to say that all buyers are going to feel great about it. So we'll just have to kind of wait and see how that works out. And then the column on the right, this says buyer financing agents commission. And technically speaking, in this scenario, yes, they're financing some of it because the sales price is being increased. But this is sort of what kind of like the 2-1 buy down, where we're increasing the purchase price in order to account for the buyer's agent commission. And then the buyer is putting down their normal down payment. And so, yes, they're going to be financing a little bit more. So they're financing some of that commission. But the key here is the house is going to have to appraise for $463,500. So, that's the deal. Is yes, it's an option, and we can do this, and I think we'll see this in some instances. But if the house doesn't appraise, then we're going to be right back to where we started. Okay, so this is just an example of how it can be handled. I'm going to slide one more. I worked up something else here. This is our presentation. Similar concept here, where the seller pays 3%, and over here the buyer pays 3%. And what I'm showing here is if you've got a client that's putting 10% down, all we're doing is we're increasing their loan amount to account for the buyer's agent commission. So their cash to close is basically about the same, and their mortgage insurance is going to go up. So in this instance, the buyer's monthly payment is going to go up by $125 a month. So depending upon the buyer, I think there are going to be options to where we can manage their cash to close to keep it okay. There is no doubt that this legislation and I think that's what everybody's talked about. It's going to impact first-time home buyers and low to moderate income families more than anyone else, just because it's going to minimize the options they have. If it does play out that way, and low to moderate income families are the most impacted, I'm fully going to expect Fannie, Freddie, FHA, and probably even VA to adjust their guidelines to allow them to roll the cost into the loan. I don't know exactly how they'll account for it, but I just can't imagine that they're going to have any choice. They're going to have to do something to help those families. So I just kind of wanted you to see a couple of different ways that could be structured. And lastly, Cory.
Yeah, this slide we also put in a lot of our presentations. Chris might swap out the picture from time to time, but what I like about this slide is really the bullet points. So why you should work with BWC Lending. One is education. So we meet with all of our buyers once they've applied and submitted all their documentation to us, we meet with them over Zoom. So we send them a link, they find a time that works best for them. We have a Zoom loan meeting where we're going to share our screen, and we're actually going to walk them through the loan application, walk them through their credit report. We're going to walk them through loan options. We're going to talk about all these things that we're talking about right now. And the goal is for the buyer to walk away with a pre-approval letter in hand and feel educated and know what a homestead exemption is, what escrow accounts are. We're going to show them all that and walk through it and share our screen. So we really want to educate the buyer. Also availability, we understand that you all work hours sometimes outside of regular business hours, nights, weekends. We're here, we're available for you. If you reach out to me on a weekend, I mean, chances are I'm going to answer my phone or get back to you very quickly. So we're available. And then, communication, we send out a weekly, a Tuesday update. The listing agent and the buyer's agent copied on it. And it gives you a snapshot of where we are at in the loan process. Have we ordered title? Have we ordered the appraisal? Has the appraisal come in yet? Have we received a final clear to close? So we send that out every Tuesday so that we're all in the same email together. And if there are any questions, all you have to do is reply all. And so we're all going to be on the same page. And then support. I mean, we're here to support you all in any way. Please reach out when you have questions about, whether it's social media or different events that you guys have. We're here to help. We want to try to promote your listings. We want to do whatever we can to help you all. And so, we're always happy to support, and chances are we're going to say yes. So anyways, that's what we're here for. We hope that we can, always earn your business, and hopefully this presentation has been helpful for you all and has got you thinking about maybe something you weren't thinking about before you joined.
With that, we will open it up. So our goal for this is for it to be short and sweet, provide a little bit of market update, but we'll open it up for any questions or you may have based on what you're seeing in the market.
I've got to run, but thank you guys.
Thank you for joining us, Shay.
Hey, Chad, I had a question. This is Christine. Hey,
Yes.
so I know election year, it's always crazy. I know it's going to depend on, what do you think trending is going to happen after the election? I know it's going to depend on, who wins kind of thing, but are you expecting, if it goes Republican, we'll see rates go down. If it stays Democrat, we'll see rates go down. I don't know if you guys have any forecast, or I'm not a mortgage expert, so that's why I'm asking. And I'm also not very political either, so.
Well, there you go. Good for you. Boy, it makes it a lot easier if you're not political.
Yeah.
Well, I'm of the opinion, I don't think it's going to matter who wins.
Okay.
I don't think it matters who wins. My biggest concern in the market for years now has really been our debt and our deficit. I think our debt and our deficit is what's going to keep sort of a floor on rates. People who think rates are, the biggest challenge we have today is people continue to compare rates to rates in the 2s and 3s.
Right.
And we're just not going to see those rates again. I think the Fed is going to learn that the amount of the things that they did during the pandemic, they just did too much of it. They pushed rates down too far for too long. And now we're sort of paying that price. So we have this hangover effect. And so my opinion is, I think my hope is that they continue to improve and we get into the 5s.
Right.
But I think 5s and 6s will be the norm for the foreseeable future. My concern, of course, is the moment they do dip below 6 is the frenzy is going to be pretty crazy. As a matter of fact, I meant to include a slide. I think Cory and I talked about it yesterday, or a stat, which is for every 1% reduction in mortgage rates, 5 million more people will now qualify to buy a house. So if you think about it, last year, we're down 1% just since November. But yet our activity is pretty slow right now. Like for a normal July, now for Houston, it could be partly because of the hurricane. But just this week, we're already seeing a little bit of more activity. So,
good.
But it's slower than normal. And so I think that if rates do continue to trend downward, which right now that seems to be what we're seeing. And I'll slide this over real quick. This is this sort of shows the price of the mortgage bond. Looked at this yesterday. Okay. And so July 2nd, so basically since July 1st, this is the price improving, meaning rates are coming down. I mean, almost 3 straight weeks of rates improving. We haven't seen that in a while, so it's been kind of nice.
Okay, good.
It's nice when you quote a rate to somebody that when they come back to you, it's going to be the same or better. Whereas over here back in May, this
Yeah.
little 2-week stretch, it was every time they call, the rate went up, and it's very frustrating for home buyers.
Right. I'm getting ready to list a little over $1 million house in the Woodlands here. And I actually got to go in a few minutes because I'm supposed to be
Okay.
there at 11. And I'm just worried because it's slow up here. And usually here it's has stayed busy, kind of like Houston. So I'm just a little concerned, and I'm trying to prep my buyer. So I appreciate the presentation because it gave me some good ideas about giving them a credit if the buyer is financing and not paying cash. So that would be a great tip, to show them. I actually snap some pictures of your slides. So to show my sellers, like, hey, if we offer this $10,000 credit, in addition to pricing it fairly, we might get a head up on some of our competition out here. So I appreciate that because it actually helps my business and makes me look better and smarter. So.
Absolutely. And so, and to that end, I will tell you that we always talk to people about price for, when you've got a listing you're trying to sell, instead of reducing the price, offering those incentives to buy down the rate. The jumbo market, you're going to be a little more limited. There are not many jumbo investors offer the 2-1 buy down. But if you've got a buyer that's, looking to go conventional, and that's the thing, our big jumbo buyers are putting 30, 40, 50% down. We're definitely seeing a lot more larger down payments. And so if they're getting into a Fannie Mae product, you could still structure it in a way, that it works well.
And what's the max on a conventional 7 what?
766, 766, 550.
766. Okay, 550. All right, I'm just thinking about down payment. Yeah, so I'm looking at like 30-something%. Okay.
What's your sales price? $1 million or?
It's going to be $1,165,000, so it'll actually be like 400-something thousand. So we'll see. It is the Woodlands. You never know what you're going to get. It's kind of like the Villages. You never know what you're going to get. But
what I can do, if you'd like, what's the address of the home?
it's not even listed yet. It's 7 Glowing Star Place in the Woodlands, 77382.
Okay. What I'll do, and you said 1.1?
1160.
Okay. All right. I'll work up a couple of numbers for you to kind of show you 1160 versus like 11, right? Like if you reduced it by 60,000,
right?
And that way you can see what it'll look like from a buyer's perspective.
All right, you're a best. I appreciate that, Chad. Thank you so much. All right, guys, I got to go because I have to get myself cleaned up so I don't look like a slug that I am for this meeting. Thank you, guys. Well, I appreciate it. It was great to see you too, Chad.
Great to see you.
Great
Thank
to
you for
meet you,
joining
Cory.
us.
Yeah,
Thank
seeing you, Christine. I hope you have a great day.
I will. Thanks, guys. Bye.
Take care.
Bye.
Bye-bye.